residential. Commercial, hard private money, not the case. It's zip code driven. It's not based on demographics, but it's based on a few different factors that will typically go into it. Days on market, average median sales price, and change in value in that area over the last year. So as a lender, we would look at making sure, once any of those three components kind of come out of whack a little bit, where, let's say, days on market goes north of 200, there's going to be like a 10% haircut on the loan amount. So if your maximum loan was 85%, you're down to 75% because the days on market is getting stretched. If you have a negative growth rate in real estate prices over the last 12 months, north of 5%, that's another 10% hit. There's a little over 14,000 zip codes in the country, and there's only about 800 or 900 of them that are showing negative growth over the past 12 months. So, most of those areas tend to be, there's a lot of noise in the numbers. I mean, obviously, these are actually numbers that come from Zillow's APIs, so they're not perfect by any stretch, but it's a tool. And
is that what you go by?
yes,
Zillow.
they have, again,
for
it's
their
just
zip code growth.
it's just a
only.
tool. We're lending across the country, right? So being tapped in and knowing everything about every market just isn't feasible, right? So it's a tool that we use as a starting point to look at. I wouldn't say it's the be-all, end-all, but there's definitely weight placed on it, to make decisions. And places like Jersey City, some of the zip codes in Jersey City, Hoboken, 5 boroughs in New York, there are some high-priced zip codes that are in that 800 or 900 that are coming down in price right now. And that's where we're seeing softness in general throughout the country, is in the high dollar price areas that really aren't supported by the rents that people are able to charge in those areas. And part of that's because interest rates, even though they've come back in a little bit over the last couple of months, we're in an upward trend in rates. So that definitely factors into investors' returns, and it's got to hit them somewhere at some point. Okay. Let's see. Hard money isn't just for fix and flips. This is one I closed in the last couple of weeks. It was a couple kind of larger commercial spaces. There's 2 vacant buildings. One of them is a single tenant warehouse type building that is vacant, that this particular borrower wanted to acquire. He bought it at auction, and we used the top 2 properties as collateral for him not to have to put any money out of pocket to make this $1.35 million acquisition. He had a property that he had bought last year, which is just partially rented now. It's a repositioning of an industrial property that has some lab space and office type space, flex industrial space as well. And the one on the left is a fully cash flowing property. It's basically 97% leased, has great cash flows. So we were able to put together a package for this gentleman to be able to make the acquisition that he was looking to make. So it's not just about 1 to 4 family, multifamily properties. It can, I don't know if anybody here is looking at these types of properties, industrial, warehouse space, there's a lot of demand in certain areas for those type of properties. Just to give you an idea of the range of types of properties that we can finance. So, as far as investors, obviously it would be a great thing for you all to be able to get both sides of a transaction, right? Meaning, not just the fix and flip. If an investor is coming in to buy something and then when they're flipping it, to obviously get a higher priced exit and to get a commission on that. That's obviously a good situation to be in. I would say the most successful investors that I've seen tend to flip single-family homes if they're in the flipping business, and they tend to rent out and refinance into permanent commercial mortgages the multifamily. And part of the reason for that is when you look at the cash flows of a property, the rent minus the expenses on multifamily properties, it tends to be somewhere in the 60 to 70% of your rent tends to fall to your bottom line before financing costs, before your mortgage, before your financing costs. So 60 to 70% tends to be your net operating income after expenses, somewhere in that range. Whereas single-family properties tend to be in more like the 50 to 60% of your rent dropping to your bottom line before financing costs. So, I would say out of hundreds of investors that I've dealt with, I think that's the combination that I've seen that's been probably the most successful of them. There are exceptions to the rule. I have people that exclusively built their rental portfolio on single-family homes. I'm not opining, but I can tell you what is most common and what seems to be the kind of easiest path for investors.
What is the NOI, net operating income? Okay.
Yep, that's a good question, and I'm sorry, since it's a sideways, since it's a vertical slide and not landscape, I have that as a separate, I have it in your packets, but I'll pull it up on a spreadsheet here so you can kind of see how this works. So this was on that 18-unit property in Easton that's closing next week. So as you'll see, there's 17 residential units here. Typically, I would list out the tenant name, which the bank is obviously going to, look at leases and verify information. So I just wanted to keep it, generic and put the number of bedrooms and bath for each unit. And then there's a commercial unit here as well. We have the monthly rent, the annual rent. So monthly rent is about $19,000 a month. Annual about $228. Just scroll down. So this is a pro forma operating statement that myself and Chris here, who helps me, put together. So this is a breakdown of the rent and expenses, or revenue and expenses on the property. And this is looked at, this is in the format that a bank would use. Some of your investors are going to leave out certain things. They're going to say, well, it's 100% occupied, so why do you have a vacancy factor? I'm going to self-manage the property, so why do you have a property management fee? A bank says there's certain things that have to factor in to this, because not everything is perfect all of the time. Even if you have 100% occupied property, for residential, they're typically going to use 5% for vacancy. For commercial, they're typically going to use 10% for vacancy. There will be variations. The appraiser can come back with something slightly different, but these are good rules of thumb. 5% vacancy for residential units, 10% for commercial. Okay, and so we'll be working our way down to the NOI, the net operating income here. So we take out the vacancy. We have their real estate taxes, insurance, their portion of the water and sewer and electric in the common areas, maintenance and repair. This is an area that gets some people in trouble that already own properties that come to me and look to refinance. They might renovate a unit or put a one-time repair into something that's not a recurring expense. You're supposed to capitalize that and use it over a certain number of years. Some people will drop it right into their maintenance and repairs on their tax return. And that could be enough sometimes to, I've seen cases where, you know, someone's maintenance and repair is 20% of the income of the property. That's obviously not feasible for a recurring, you know, revenue situation in most cases. So my standard default, I'll use 3.5%. Most banks will sign off on that number. Maybe they'll tweak it a little bit. Trash, again, utilities, sprinkler, fire monitoring. These are kind of specific to this property. General administration, property management. This gentleman is going to self-manage, actually the couple's son is going to self-manage the property. So why do we use 5%? Well, the bank says, if you fail, and I ever have to take over the property, God forbid, we don't want to take over the property, but if we ever had to, we're not managing it. We're going to farm that out to somebody. You need to put a number in there. I try to get away with 5%. Property management fees can be as much as, you know, 10% or even more in some cases. But for larger properties, this number tends to work, and most banks will buy off on that. The other thing that banks will want to use is something called replacement reserves. They know that you're going to need to save a little bit of money for, you know, for these non-recurring items as they come up. You know, when a roof needs to be replaced, when a water heater needs to be replaced, a boiler, you know, etc. So this isn't an expense out of someone's pocket each year, but they are doing, the bank is going to do the math and say, well, you need to kind of factor some of that out of your income to have a realistic number that will balance out over time. So in this case, for residential, I'll typically use $175 per residential unit per year. And then for commercial spaces, I'll typically use 25 cents per square foot for commercial space, 25 cents per square foot. So this actually needs to be bumped up slightly. This is just the residential component. So when you add all these items up, all these expenses, it comes to $77,800. That's against the after vacancy number of $216,000. So before financing, that leaves this investor with $138,510 of estimated NOI, net operating income. If they own this property free and clear, that's how much would be going into their pocket effectively. It's not free and clear, they're putting a loan against it. So this property they bought for a little over 1.7, but I just used 1.7 to keep round. They ended up borrowing 1.1 against it. That means they're purchasing it at what's known as a cap rate. Does anybody know what a cap rate is? A cap rate is, if you were an investor, this is your rate of return if you bought a property in cash. So if you spent $1.7 million on this property and you were getting $138,000 a year of net income, you just divide the net income, the net operating income, divided by the value or the price that you paid at the property, and that's 8.15%. So if they were buying this cash, that's their annualized expected return, assuming nothing else changes. So when you hear, okay, well, you know, this property is offered at an 8 cap or a 9 cap or a 10 cap, the higher the cap rate, the higher return the investor is getting. So investors want to pay higher cap rates because that means they're getting more income relative to the sales price or a lower sales price relative to the income. For properties in the Philadelphia area, for multifamily, you know, you're typically be able to buy something in the, you know, 7 to 9% range in terms of cap rates. Places like Hoboken or some parts of New York, sometimes these cap rates are 3-4%. So think about the risk that you're taking just from saying, okay, well, if everything works well, I'm gonna get a 3 or 4% return on my money. And if real estate prices go down, all you have is risk. You really don't. So it's been a great trade for these investors over the last, decade or two, but how much higher can prices get pushed to bring the cap rate down relative, so that, unless the income is going up along with the sales prices, you're really just kind of taking on risk at this point to buy 3 or 4% returns in real estate. So that's NOI, that's how you calculate that. So for the loan, I did your typical, most common loan that I mentioned, a 25-year amortization. I used the 5 1/4 rate, 1.1 million. Their annual mortgage payment, it's obviously paid monthly, but their annual mortgage payment is about $79,000. So when you take the net operating income and subtract out their annual debt service or mortgage principal and interest, that means that the cash flow that you have remaining to put in your pocket after financing is about $59,000 a year. Not a bad do, right? The debt service coverage ratio is how many times your net operating income can pay the mortgage payment per year. So 138,000 divided by 79,000, 1.75 times is how much your net operating income can cover your annual debt service. This is a key number or metric for banks. As I said, there's two things that can limit your loan amount with a bank. There's the appraised value relative, could be the sales price. They're going to go off of lower of appraised value or sales price, just like any other transaction, and the debt service coverage ratio. Most banks, by and large, have a minimum requirement of your net operating income has to cover your debt service at least 1.25 times. That's the bare minimum. There's people that will buy properties with a 1.25 debt service coverage ratio all day long. Turnkey properties, they're not, they're more passive investors. They're not looking to renovate or rehab or do anything like that. This one at a 1.75 debt service is somebody that is coming in. They want to spruce up the property, put some money into it as the units turn over, and they want to be able to raise rents. This particular property also has a parking lot that's not being used in these calculations. The current owner, for whatever reason, is not really utilizing the parking lot. This guy comes in and says, well, geez, even if I can't get approval to build, which is what he's looking to do on that parking lot, which is based on the as-of right, or what zoning will allow based on no changes and no variances to the current situation, he believes he can actually build on it at this point. But the current owner just had this property leased up. It's obviously attractive cash flows, and just decided not to try to maximize, what he could do with the property. Even if this gentleman that's buying it, that's actually it's a family, a husband and wife, and their 21-year-old son who's going to be managing the property. Even if they don't decide to build, it's very easy to take this parking lot and rent it out to a contractor. There's demand in that area. They can get an extra, probably $1,000 a month or so renting out to a contractor for the space. Does anybody have any questions on the numbers? I tried not to do too much in numbers, but it's important to know just at least the basics. The rent roll, the operating expenses, when you take out those expenses, and some of the other things the bank wants you to take out, or maybe not you, but the person that's bringing the financing package to the bank. If you had this same buyer of this property go directly to the bank, and they didn't have anything in for property management and nothing for reserves, maybe they'd have something for maintenance or repairs. They might not have vacancy in there. The bank would look at them and say, this is not realistic. What else in your financing package is not realistic? Or what else, you know, do we really need? It just puts their antennas up to, you know, but when you come in with something that makes sense from a bank's perspective in the way that they want to look at it, then it really helps facilitate and make the process substantially easier. Yes?
So yearly, the profit is 59410?
Yes, after the mortgage payment, yes.
Okay. What do you do on your taxes when you make 59410?
Okay, so there's, there's a couple different things. This is the cash flow on the property. On your taxes, you know, when you look at a Schedule E on a tax return, whether it's on your personal return, let's say if it's an LLC that you own it in, and it's flowing through to your personal return, or if you have, let's say, some people, let's say someone has a subchapter S Corp and they file a separate tax return, which is in a 1040, I think it's an 1120S. And a partnership, I think, is an 1165. There's also a Schedule E in there, and there's certain expenses that you will list on the tax return, and there's certain things here that are not going to be on the tax return. If this person is self-managing, that property management fee is not going to be on the tax return, right? Certainly this reserves is not going to be on there. That's like a, you know, mental savings account, mentally segregating some money for when, you know, when there's a rainy day and you need to fix, you know, something that's abnormal. Vacancy is not obviously going to show on there. You're going to show whatever your actual rental income. But these other expenses, taxes, insurance, water and sewer, electric, whatever your actual maintenance and repair is, trash, all these things are going to show up on your tax return. The other thing that's going to show up is a non-cash expense, depreciation. Okay, so these properties can be depreciated over a certain number of years. You can list a non-cash expense for depreciation on your tax return, so it reduces how much taxes you have to pay, but it's not actually reducing money out of your pocket. It's not a cash expense that you're paying.
So in the end, after taxes, might that 59410 mean that I made 40,000 versus?
Well, let's take the 59, we'll add the 11 back in, right? So we're up to 70. Let's say this is accurate. Let's say you're self-managing. We're going to add another 10 back in. Okay, so you started at 59. We added about 20, 21, so that's 80, right? So you're at 80 of income that you're showing, and then you take the depreciation off that. Let's say it's $10,000 or something.
Yeah, my interest is how do I stay looking good on paper as far as credit?
Yeah.
So for my next opportunity, it looks as though,
Yeah.
you know, I've got 80 coming in when actually I really only have 40. I don't know.
Well,
Am I?
I don't know if
saying
you
it
can change the
backwards?
numbers that much, but there's certainly flexibility in, you know, how people, and variation in terms of how people report. And sometimes people aren't showing all their rents, okay? Obviously it's illegal. They're also shooting themselves in the foot from, if they're looking to refinance it in the future, the bank's gonna say, well, this property doesn't cash flow. I don't care what you tell me the rent is. This is what's on your tax return. So, you know, it's kind of straddling that line of creative accounting, you know, versus making sure you're, you know, A, you're not going to jail, and B, you know, you're not shooting yourself in the foot from a financing perspective. It is, it's a common, you know, misconception that, I don't know if misconception is the right word. I would say, you know, your average typical real estate investor, you know, not somebody that's a huge investor, but, you know, your typical, you know, got a couple owns, you know, 1, 2, 3, 4 properties, you know, something along those lines, the average real estate investor, credit scores between 650 and 690, they maybe show, you know, $50,000 to $80,000 a year of adjusted gross income on their tax return. But when you add back in things like depreciation, which you do when you're at the bank, that brings up your allowable income, that, like, for example, depreciation. But a lot of people aren't particularly strong on paper. They're not terrible, but they're not particularly strong. There are people that, there are obviously larger, you know, more substantial investors that have incredible, you know, net worth and you know, equity in their properties and are showing great cash flows. I just did a loan for a guy that, a young guy that owns 50 units. Almost all of them are free and clear. His tax return, he buys them and renovates them, so he's in his repairs number, he's putting in his renovation costs, or, you know, his accountant is. His tax return, he barely showed north of break even, but his cash flow from these properties, his real cash flow, you know, $150,000 to $200,000 a year. So there's sometimes a difference between cash flow and taxable income. And, you know, we definitely, you know, one of the first things that we do, in addition to looking at someone's personal financial statement that they fill out, is take a look at the tax returns and see what kind of story they tell. And, you know, if we need to address anything up front when bringing something to a bank, you know, we need to know that up front. We're coming into filing season again, assuming someone doesn't file an extension. People will come to us and say, here's kind of a draft of how I think I'm going to file this year. Can you give any, you know, insights? And sometimes we can help, you know, tweak things. Again, I'm not an accountant, I'm not a CPA, I'm not an attorney, but sometimes we can help people, you know, stay on the right path so that they don't shoot themselves in the foot, just to minimize their taxes and then not be able to, you know, finance properties. That's all I have for prepared remarks. Does anybody have any other questions?
How do you get definite rent rolls? Is that public, or you're looking at buying something that's already rented? How do you get, I'm having a hard time getting the listing agents to give an accurate number about those rent rolls.
Well, so that's a good question. If you have a buyer that's buying a property and they're financing it, the bank is going to require that the seller provide whatever leases are on the property. It doesn't mean that every property is going to have a proper lease. Some will be month to month, some will be expired, some will be, you know, whatever, but they're not just going to come to you with nothing. That's you know, that's not really acceptable from a bank's perspective. They might come to you with 75% of the leases, you know, and the bank will factor in, okay, you know, these other units are leased up. You as the agent representing the buyer, or the buyer themselves, might not want to have the property fully leased, because maybe a lot of times the existing owner doesn't have things up to market rent, and they want to come in and they want to either turn over the people that are there, or just start raising rents, or start renovating so that they can raise rents. So a bank gets that, and they're not going to, you know, require, you know, 100%, you know, current leases. You know, this property, again, there's, you know, 17 residential units. I would say there's 3 or 4 of these units, residential units, that have leases that are not month to month, that are like a 1-year lease that's still in force. All the rest of them are month to month. The bank is okay with that. The buyer is very happy with that. The commercial space is leased up. One thing you'll see in commercial spaces is they're typically longer than 1-year leases. They're typically 3 to 5-year leases. So although the vacancy factor is higher for commercial, if it goes vacant, it's typically going to take you longer to get somebody in there. The leases last for longer, so that's kind of a double-edged sword. But I mean, the seller is gonna have to provide, information. They should provide a rent roll, they should provide, a substantial number of the leases. When the appraiser goes in there, the appraiser is going to, do a check of each of the units typically, make sure that someone says it's rented out, there's actually someone there. And they'll take a look at the current stated rent roll, and then they'll look at what the market rent is for the area. So they'll typically use the current rent for whatever units are rented, and they'll typically use the market rent for the units that are not rented. But banks want to see things, fairly much rented. Private lend, if you have something that's vacant, a lot of banks are not going to want to touch it. Then you typically have to go private money, hard money first, as a transitional step, do your renovations, repairs, whatever you're gonna do, get it fully leased up, and then bring it to a bank. Yes, it costs you more, because you have to finance it twice, you have title costs twice, you have attorney, you have, et cetera, all these expenses, but that's why you're typically able to use private money to get properties at a discount, and close quickly, and, it leaves some room to make money for those that, are, looking to actively add value to their properties.
This is a little creative,
Okay?
but a situation in the university area where we were renovating, and we actually leased over up to 1 year, because the universities tend to get the students to prepay a year in advance, even before they move in for the semester.
Okay.
Is that usable? They prepaid, they've got a lease, they're coming in for the January semester or the
So
September
is someone,
semester.
it's someone that owns it now and is
Mhm.
looking for financing, or you have someone that's looking to buy that?
I'm looking to buy it, and the way they're gonna buy it, but it's vacant now.
Mhm.
So you're saying the banks don't really want vacant?
Oh, I see, okay. So if you're buying it in the, let's say, the summer, when there's no students in it,
Uh-huh.
and there's 1-year leases that are,
Mhm. Sometimes 4, if they're freshmen.
okay. Yeah, I mean, that would be, that would be usable.
Okay.
Yeah.
Did you say that you could write off the maintenance and repair, all the maintenance and repair that you use, like on an investment property, or?
Well, you, on your Schedule E, it's going to have a line for repairs. So if it's something that's, general repairs, people will put that down. The place that becomes questionable is if you're putting a capital expense in to, replace a roof, or, a higher ticket item that's not a recurring type of expense that should actually be taken over a number of years. That's where things kind of become, a little murky. Some people will include it in there, some people won't, but it can impact your financing potentially.
And also another question, if you were like looking to get like a down payment for another like investment property, and you did, like, would you recommend like a cash out refinance or like a HELOC against the other property? So like.
Okay, so, are the other properties, so we're talking about not a primary residence, we're talking about other properties being investment properties?
Yeah, like a duplex.
Okay.
or a duplex, yeah.
So, so banks aren't typically going to be very keen on doing a high loan-to-value type HELOC against an investment property. I can tell you from, obviously, if you have a personal residence and you do a HELOC, that's the cheapest financing you're gonna get anywhere on any type of property, right? Effectively. If you're looking to tap equity in existing properties and it's owned in an entity, so you're doing a commercial style bank loan against it, or a private money loan, depending on the situation, you can typically, let's say it's a property that's been held for, a few years, it shows on the last 2 years' tax returns. A bank will generally go, okay, well, we'll do a 75% loan-to-value loan against the property, or 70% maybe, okay? If the property is something, a lot of times you'll see someone will, a rehabber will come in, an investor will come in, they'll rehab it, they'll get it leased up, and then they'll say, okay, I wanna get all my money out, and I wanna take an extra $100,000 out, because, you know, I've sprinkled some pixie dust and it's worth $500,000 more than I have into it. Banks are like, I don't think so. They, you know, over the last couple of years, banks have started to kind of tighten a little bit on cash out refinances before the paint's dry on the renovations that someone's doing. Doesn't mean you can't do it, but it's a lot more difficult, there's a lot less banks that are doing it, and you better have an investor that is organized with being able to show their income and expenses against a property and to produce, you know, reports so that the bank kind of feels like the investor knows, you know, what they're doing, they have an actual business model, and because it's not in the tax returns, you know, it's, they're going off of like a pro forma number, or not made up, but, you know, it's a number that is hypothetical that should occur if everything goes well and, you know, et cetera,
But it's harder.
yeah, it's harder.
Yeah.
Equity lines of credit against commercial properties, a commercial bank-style loan, most lenders are not going to go above 65% for a line of credit as opposed to a cash-out refinance of like a mortgage. Okay?
But well, whether it's like a individual or commercial, you can, like, if it's your own house though, you can take usually more, you're saying? Or
Yes.
Okay.
This is just for commercial.
65.
This is something that's owned by one of your entities, and it's you know, we're looking at a bank for a commercial style mortgage, not a Fannie Mae, Freddie Mac conventional loan. You can typically get up to 65% for a line of credit. You know, or you can do a straight cash out refinance as much as 75%. Not all lenders will go 75. It depends on the circumstances. Depends on the cash flow, depends on the strength of the borrower / guarantor. Is it a property, is it an area that the bank likes? You know, is it a property type that the bank likes? There's some things that go into it. You can also do private money cash out refinances, you know, typically between 60 and 70% of the value of a property, so.
But when you say the 65%, that has nothing to do with what the mortgage is, that's just the price of the house?
The appraised value of the house, yes.
So even if your mortgage is like, whatever, 20,
Well,
it doesn't have any,
So the loan to value will factor in, I mean, if you have, are you saying if you have a first mortgage against it, and you're taking out an
Yeah.
additional line? I mean, that's the combined loan to value.
that's it
And
combined.
guess what? On commercial properties, banks are not gonna wanna sit in second position. So I would say the only source of, you know, traditional type lending that a borrower could look at with that is they should go back, if someone has a first mortgage against a commercial property and they need to tap more equity, other than doing a complete refinance and paying off the other loan, so the new bank sits in first position, you could have, you could go back to the existing lender, sometimes will do a second against their property. Commercial loans have written into them that, you know, you need bank approval in order to put a second lien against the property. So, second liens are just not particularly common in commercial financing. And if they are, they're expensive if you get them. Any other questions? No? Thank you all for your time. Nice
Thank you.
meeting everybody. My contact information is,
That was awesome.
oh, thank
That
you.
was really good. Thank you for including that.
You're very welcome.
The whole packet was, but that was really educational.
Thank you. Yeah, the thing I put at the last page just kind of gives a target of, you know, kind of what we're looking at for minimum loan amounts and target loan amounts for various types of loans. Doesn't mean we can't do something outside those parameters, but, you know, just kind of use it as a reference point. If you have any questions, I'm almost always available, you know, just reach out, email, text, phone, whatever the case might be. All right.
And you do all the good stuff we talked about, right?
Yes,
All right, thank you.
thank you. Oh, they're probably cold by now, but Christie picked up some tacos. What do you?
I'll eat a cold taco.
Does anybody here know John Flegg or no?
Yeah.
Oh, yeah.
Yeah, he said, he advertised it as like Taco Tuesday or something like that. I don't know.
Thanks.
I've known John for a lot of years. Actually, I went to high school and college with John. So I've known him for a long time.
It's food, we just want food.
Okay.
I love that.
Thank you.
Make your own, it's hard, probably not that bad, but one can't hurt.
I love that.
So,
So he's gonna be owner occupied on the new one.
Yes.
That is awesome.
Is he buying it in the same area as the other one?
My husband and his brother do. Yeah, they're investors, yeah. They just don't know. Well, it gives me an advantage for people that want to invest, you know. So I love dealing with investors, but I never worked with hard money or commercial financing.
Yeah.
So I've always wanted to learn about it. But yeah, yeah.
Well, that's nice
Yeah.
for you.
Would you live in something?
Yeah. And I've always done their financing.
Oh, wow.
Other than for if you're an owner occupied business.
Yeah, I just tell them, sign here, sign here, sign here.
Operating company and you reside in, the business resides there. That's different than being owner occupied residential, which is effectively what we're talking about. Banks, or commercial banks are not looking to finance owner occupied residential. So that would typically leave you with the more conventional methods, the, Fannie Mae, FHA, Freddie Mac, like a regular FHA, yeah.
Do you want
So
to
he's
talk
going
about
to.
it?
Oh, no, thank you. Yeah, thank you so much for
The bank's
asking.
gonna
Yeah. I'm good.
Thank
Thank you so much. It's
We're just trying to put a small down payment.
right around here.
And the
And
bank-
that's trying to do.
Yeah,
We actually signed up,
I'm just doing,
signed up to do their 3 days.
Yes.
So I went to that, it was like a Friday, Saturday, Sunday, all day long. It comes. It was around this. I wanted 12 hours a day. Like, I was like, okay, all the time, I had my brain, but it was. Yeah. And
it's been spending a lot of time. Sounds like wasting a lot of your time. It's one of the biggest challenges that I have, too, is there's only so many hours in the day.
put a couple things in and you don't get anything back.
yeah, it's like one thing increases the next. So it doesn't talk like exactly after this.
I tried to find that, right over my neck, and I'm like, right, you're even
No,
like,
I haven't even done part-time. Right.
yeah,
Well, now I'm kind of just waiting.
You know, just my
to
son
figure
once
something
rented a
out.
place up in Upper West Eddy. We drove right by the Browns, the auction house. And I'm like, oh, and my grandmother was, and she's like into antiques. When I was a little girl, so I was, and actually my husband and I would go to a restaurant. I would be in a restaurant. We owned at the Golden Nugget, the freestanding building. That was our restaurant years ago. Yeah.
but he never stopped to remember that.
Not my husband, and he's the one who.
Well, tacos aren't so bad.
Really not. Jerry Bristol, he actually sold to the guy who owns it now, so. And then he
what's
had
the name of
seals
that
for
nail
ourselves. He had the bagel place, which was in the Levittown Shopping Center prior to it being renovated. So where Home Depot is now, that's where his restaurant was. So,
I think they're closed Sundays and Mondays.
yeah. So I keep trying, so now, yeah, he has a Wawa now.
And how
And
much?
I keep telling him, because like he wants to like kill people at Wawa, like every day. He comes home, he's like,
Yeah.
get your real estate license, you need a commercial. And I'm like,
Yeah, they're I have to wait. I'm over a month.
There's a lot.
That's
why I love it.
75% on the value, that's 120.
I ask you for so much other things. I don't want to ask you for something so petty.
Basically,
So,
so 115 is going to be
Today,
we were there, I wanted
they open at 10 on every day but Saturday. Saturday they open at 9, but they stay open till 7, except Saturday they're closing 6. 10 to 7 every day.
Hold out till next Tuesday.
Okay, the date. Yeah, I did love this one. That's the 29th. Perfect.
Maybe we can make an appointment for the Saturday before I go, but.
That'd be good, yeah, because you're long enough then you could, yeah. If you wanted to get them done now, just to see how you like them, no? Okay. But you can make an appointment. Get that far away and, that would be good.
what a way to get
Oh,
out of
nice.
I want to get my hair
Oh, how nice.
So,
Do you know where to go for that?
This is what,
I'm gonna
this
go
is
where
what I
my
did.
Kim
because
Delaney
I
straight
was
and down.
Oh, by,
completely not, because I was afraid to keep my coat on.
very
Where,
good.
Garden Beach?
oh, yeah, yeah.
Two cups of
Oh, I didn't even know it was their place.
Yeah, it's called Yin Zao.
Oh, I thought that was a place by,
Yesterday?
Yeah, so I went with him, and my mom's like, "There's love for the scarf, so you don't know what you're walking into."
you know where the Walgreens is on New Falls Road? By, there's what do you call it, place there too,
Take those quick, take those quick, we can come back our work or take. It was so bad, I was like.
for a registration place there
Oh, I
too.
know.
You know what I mean?
Oh, Thim's used to be there.
Oh,
Kelly used to be
now
there.
that you say that,
I can't
yeah.
now.
Oh, it's there, but it has a different owner.
Oh,
It's called something.
you say that, yeah, that was the name of it.
Yeah, that's Because there's a barber shop there too.
Oh, bye-bye.
Conventional method.
Sounds like, no way, I'm not, because I want you coming for that place.
Bitter, it's bitter.
Yeah, my husband actually took off a week, and my daughter. They could not get out of the house. They just. They grew up good.
Yeah.
Let's go. That's our real dad.
Yeah.
Well, I didn't have anything else I didn't know about it. Each day I was questioning where that's in this place.
Yeah.
It's not as bad. It's not as bad. Yeah.
I saw those poor kids standing at the bus stop there this morning, and they're all like, they look, I'm like, do I stand here and let them in the car for a couple of minutes? I know. I'm like, I thought they did all that off yesterday, because I actually, I was reading to them every day at the bus.
Yesterday was a holiday.
Yeah.
I go to
But, yeah.
close for the cold, and my
Yeah.
daughter said, it's a holiday, Mom, why do you get home?
Yeah.
Yeah.
I am.
Oh, we're not
not getting mail unless I said so.
Yeah.
Can't do anything.
The work,
I'm not gonna go back out, I've got my coat on, I pulled the driveway, I got, duh.
Yeah.
Well, it's the cold,
That's
I'll
not
wear
my
it
she,
on.
she drove yesterday, so it took me like a while to figure out it wasn't a drop day. It was a holiday. Then she said something was happening on Thursday. I'm like,
Okay.
why on Thursday? She's like, it's my day off. I'm like,
What? Yeah.
she's like, it's a holiday today. And I go, oh, we're not getting mail?
I know. Yeah, that's what I would, I focus exclusively on the commercial side. Whether it be private money or,
Okay.
or bank stuff.
All right, thank you.
Very nice talking to you.
Yeah.
All right, thank you. Have a good day. Thanks for coming.
I have a quick question.
Yes.
So your hard money lenders generally about how long does that take?
2 to 3 weeks.
2 to 3 weeks on hard money? She sometimes uses that.
What area, what type of,
He's asking the city now to, when you run to the left hand.
okay.
Hard money, because it's all money, his cash flow is tied up in his project.
That's something I forgot to mention, that is one of the most common situations that I run into. Some people, I just want to buy this property cash. They get stuck in the middle, and they want to do something
That's
else,
right.
and they have no liquidity to show.
when you got older,
Very common.
Well,
in this space. So, definitely want to address that, you know. I mean, as far as liquidity, he just needs the down payment and closing costs and be able to show.
Yeah.
Reserves. Doesn't have to be just.
Oh, absolutely.
reserve.
Even just like using sprinklers, something like if I'm in here,
You know, the nice thing in the
I'm
hard
just
money
gonna
world
go outside to go,
is
I'm gonna
that
walk around,
we're
like
not
it's like,
sourcing
just clean your
assets
head,
for
walk,
because
so
it's been the last
like
6
you
to
just
8
feel
years.
better, it's like,
Less to see the
Right.
paper trail. We need to see it in the account, we need to make sure that, we need to be comfortable with it's not.
Yeah.
Okay, but people have a relative friend or whatever.
Yeah.
that, all of a sudden
that's my
money
issue
gets
with my
taken
neighbor,
out
he's,
before closing,
he's
that's
such a
okay.
good cook,
Right.
and he just,
Okay,
every
so
food
That's okay.
is like, oh, well, let's get this, let's get this, but it's like,
there's no
oil,
way.
oil, I'm like, do you use ham? Oil, he's like, this is the way you gotta cook it, I'm like, dear God, we could,
Possible.
I know, he's a good guy, he's a good guy, but
Situation, I don't know anything about
I know,
finances,
he's,
I don't know anything
it's
about
like,
I'm cool.
it's quite nice, and I said, I love to cook. So I said, I'll always order prep, like I'll chop the vegetables, I'll cook prep and clean, but I said, the cooking part, I can't, I'm so bad. I try.
I have that.
Other funds.
Yeah, I mean, so
Your husband's in
I do a few different things.